The Federal Reserve is expected to announce a rate cut next week. Why is the Fed cutting rates? Is it because the economy is booming? Is it because corporate profits are exploding? No, they are cutting rates because they are afraid. The Fed is cutting because the economy is slowing down. They are attempting to prevent a recession. Looking back at history, the start of a rate cutting cycle is often accompanied by a market correction, not a surge. In 2000, rates were cut. The dot-com bubble burst. In 2007, rates were cut. The housing market collapsed. To the vast majority of observers, this seems like one of the most glorious moments in American financial history. Headlines from major financial media outlets are still tirelessly scrolling news that the S&P 500 and NASDAQ are approaching all-time highs. Wall Street analysts continue to throw out dizzying price targets, as if this feast will never end. But as an investor positioned in the market at this specific point in time, I'm guessing your current feeling doesn't match the excitement in the news. If you imagine the S&P 500 index as a single company, its surface performance looks brilliant. But if you take a scalpel and slice it open, you will find that the internal organizational structure is completely unbalanced. Data shows that in the past 12 months, the vast majority of the index's gains came solely from those 6 or 7 well-known tech giants, the Magnificent Seven. These companies have trillion-dollar market caps, and their weighting in the index is so massive that a 1% rise in their stock prices can mask the fact that the remaining 490-plus companies dropped by 1%. It's like having Elon Musk sitting in a room with 499 average wage earners. If you calculate the average wealth of that room, everyone is a billionaire. But does that change the reality that those 499 people still have to worry about their mortgages? Obviously not. The current US stock market is that room. This is why you feel torn, because you live in the real economy represented by the remaining 493 companies, while the index lives in the grand AI narratives and capital bubbles woven by those 7 giants. This division reached its extreme in 2025. A large number of small cap stocks, traditional manufacturing, and even consumer stocks have not only failed to rise over the past year, but have actually experienced a stealth bear market. But this pain has been concealed by the gloss of the index. For middle-class investors, if your holdings weren't extremely concentrated in those few giants, you were essentially just a passenger or perhaps even losing money. The end of easy mode, the side effects of passive investing. Looking back at the past 3 years, 2023 to 2025, we must admit that we experienced a rare period of easy mode in investment history. The core logic of that period was excess liquidity superimposed on a single technology narrative. In that phase, investing didn't require much brainpower. Massive amounts of capital flooded into the market mindlessly through ETFs. Here is a mechanism you need to understand. When retail investors buy an S&P 500 ETF, they aren't making choices. The fund companies take the money and mechanically buy stocks according to their weight. This means the bigger the company, the more money it gets. The more money it gets, the faster the stock price rises, the faster the price rises, the larger the market cap, and the higher the weight. This is a self-reinforcing positive loop. This created an illusion. It seemed that as long as you bought tech stocks, you would make money forever. This means that the close your eyes and buy the giant strategy will not only fail in 2026, but could also become the biggest killer of your assets. Smart money's great retreat and great rotation. A more alarming signal comes from the movements of institutional investors. If you could see the institutional level trading data like I do, you would discover a disturbing phenomenon. While retail investors are still excitedly buying call options at high levels, Wall Street's top fund managers are quietly conducting a historic portfolio adjustment. They haven't liquidated and left the market because they need to stay invested, but they are deleveraging and reducing risk at a very fast pace. They are pulling capital out of those overcrowded, overvalued hot tech sectors. This is why you've recently noticed that even when some tech companies release good earnings reports, their stock prices plunge because big money is using the good news to offload shares. In trading psychology, this is called distribution. So where is this money going? It is flowing into corners that the market has ignored for 3 whole years. It is flowing into interest rate sensitive assets, flowing into traditional industries that have real cash flow but are undervalued because they lack an AI concept. This is not just a simple position adjustment. This is an advanced bet on the drastic macroeconomic changes of 2026. Wall Street's elite know very well that the underlying logic that supported the bull market of the past 3 years, high inflation, high growth, high interest rates, is about to disintegrate. Replacing it will be a new cycle of low growth rate cuts and high uncertainty. Why 2026 is critical for middle class investors. For ordinary investors like you and me, this final month of 2025 is a critical window that will determine our wealth destiny for the next 5 years. Most people are reactive. If you continue to operate in the 2026 market with a 2024 mindset, the result is predictable. You will perfectly catch the high-priced chips thrown out by institutions. We need to shift our gaze from those noisy news headlines and focus on the core variables that truly determine the market's direction. This core variable will be unveiled by the Federal Reserve next week. Most people think it is the bell signaling a rescue, but in my view, it looks more like the starting gun for a new round of the game. In the next section, I will deconstruct for you in depth why is the upcoming rate cut potentially the biggest trap the market has set for you. Now, we must dive deep into the bottom-most logic driving global asset prices, monetary policy. In a few days, the Federal Reserve will hold its final FOMC meeting of the year. According to current futures market pricing, Wall Street is almost 100% certain the Fed will announce a rate cut. For the vast majority of retail investors and novice market participants, their linear thinking goes like this. Rate cuts equals money, gets cheaper equals stocks go up. If you are preparing to rush into the market holding this simple idea, you are standing on the edge of a massive misconception. Let's look at the real economic data at the end of 2025. This is what those bullish influencers won't tell you. Cracks in the labor market. Although the unemployment rate hasn't skyrocketed, full-time jobs are disappearing and new hires are mostly low-wage part-time roles. This is a very typical precursor to a recession. The excess savings accumulated by U.S. consumers during the pandemic hit absolute zero in the third quarter of 2025. Current consumption is being propped up largely by credit card debt. Delinquency rates are rising. Wave of bankruptcies. The number of bankruptcies among small and medium-sized enterprises has hit a 10-year high. So the rate cut coming on December 10th is not to celebrate economic prosperity, but to resuscitate it. Historical data does not lie. Looking back at the start of the last three major rate cutting cycles, 2000, 2007, 2019, you will find a startling pattern. The moment the Fed cuts rates for the first time is often not the bottom of the stock market, but the top or the final rally before a crash. Why? Because the action of cutting rates itself is an official confirmation of an economic downturn. In 2026, we will see a massive amount of corporate bonds issued during 2023 to 2024 at high rates coming due. These companies must refinance, borrow new money to pay off the old. Even if the Fed cuts rates now, the new interest rate levels will still be far higher than the zero interest era they enjoyed years ago. This means that corporate financial costs will not decrease in 2026. They will essentially rise. This lag effect acts like an invisible noose, slowly tightening around corporate necks. Especially for those pseudo-tech stocks and PowerPoint companies that lack positive cash flow and survive solely on financing, the first half of 2026 will be a test of life and death. The great asset repricing, who wins, who loses. Understanding the macro background, let's see what this means for your portfolio. A rate cut doesn't mean all stocks will fall. It means a complete shift in capital preferences. In the past era of high interest rates, 2023 to 2025, capital had a simple destination: money market funds. Since you could earn a risk-free 5% return just by keeping money in the bank or buying short-term treasuries, why take the risk of buying stocks? Or, if you had to buy, you would only buy those cash-rich giants like Apple, Google, because they don't need to borrow money and can even earn interest on their massive cash piles. This is the fundamental reason for giants up, small caps down over the past few years. However, with the opening of the rate cut cycle on December 10th, this logic will be overturned. Risk-free rates. Keeping money in the bank isn't so attractive anymore. The massive $6 trillion locked-in money market funds will be forced to flow out, looking for new sources of yield. The $2,026 logic from harvesting to releasing. We cannot ignore the US dollar index. For the past few years, a strong dollar has acted like a vacuum cleaner, sucking up global liquidity and causing emerging markets to wither. But as the Fed cuts rates, while the European and Japanese central banks may lag in their actions, the interest rate differential between the dollar and other currencies will narrow. The logic is very clear. The dollar will enter a depreciation channel. For investors holding only dollar assets, US stocks, US bonds, This is an invisible risk. Your purchasing power is shrinking. But for investors with a global allocation, this is a huge opportunity. A weak dollar usually means commodities, gold, copper, crude oil, because they are priced in dollars. In 2026, not all valleys will be filled. Some so-called undervalued stocks are actually value traps, destined for elimination. Especially that AI sector everyone is talking about, it is undergoing a brutal process of defaking. In the past 2 years, a massive number of so-called AI application companies have emerged. Their core business logic is actually very thin. They simply call the API interfaces of OpenAI or Google, build a pretty web page or app, and charge users a subscription fee. Technically, these are known as wrappers. Before 2025, they could survive, but by 2026, the capabilities of the large models themselves are becoming stronger and more general. But what is the core purpose of AI? It is to increase efficiency and cut costs to reduce headcount. For the past 3 years, NVIDIA has been the undisputed king because the whole world was doing one thing: training. Everyone had to buy shovels to dig for gold, so the shovel seller made a fortune. But at the end of 2025, this logic is undergoing a subtle shift. As large model training is completed, the focus will shift to inference, that is, letting AI run in practical applications to solve problems, generate content, and control machines. What does this mean? It means the demand for hardware is shifting from extreme high performance to cost-effective ubiquity. In 2026, capital will frantically chase the owners of vertical domains. Only those companies that possess exclusive private data can train useful agents. The endpoint of analysis is execution. In the coming 2026, here is the suggested allocation model: 404020. 140% defensive end, building a dividend moat. The core task of this capital is anti-fragility and providing cash flow. In the early stages of a rate cut cycle, the economy is often accompanied by the shadow of a slowdown. No matter how tech stocks correct, basic living needs are rigid. Allocation direction: focus on utilities, consumer staples, and big pharma. These sectors typically possess stable free cash flow and high dividend yields. When growth stocks fluctuate violently due to high valuations, the dividends and low volatility provided by these bond-like stocks act as a stabilizer for your account. Operating principle: do not seek to double the stock price, seek only to beat inflation and avoid drawdowns. 40% offensive end precision sniping at the new cycle. The core task of this capital is to generate alpha returns. Thoroughly discard the lazy thinking of buying broad market indices, withdraw funds from the crowded tech giants, and precisely inject them into the undervalued areas benefiting from rate cuts in hard tech. Allocation direction number A: the Russell 2000 Index. This is the main recipient of the Great Rotation. Rate cuts will directly improve their balance sheets, bringing about a Davis double play of valuation repair. Allocation direction B: energy infrastructure and edge-side chips. These are the core winners of the second half of AI, as analyzed in the third section. Operating principle: build positions in batches. Buy during market panic pullbacks rather than chasing highs. 20%. Insurance and dry powder. Never gamble with a full position. This 20% determines your ability to survive in extreme market conditions. 10% gold hard assets. This is a hedge against the dollar credit system. If Fed rate cuts lead to a resurgence of inflation similar to the 1970 seconds, gold will be the only asset that protects purchasing power. 10% cash USD, short-term treasuries. In Wall Street terms, this is called dry powder. 2026 is bound to see black swan crash moments. When the vast majority of people are panicked because they are trapped in full positions, this cash is your only ammunition to loot premium chips at floor prices. December 2025 is a watershed moment. Over the past 3 years, luck has masked a lot of strategic laziness, but in the coming 2026, the market will cruelly punish those blind followers without logic and reward the few who have not only understood the macro trends but also have the discipline to execute their allocation. Investment is not a sprint to see who runs fastest. It is a marathon to see who survives the longest. In this market full of noise, maintain independent thinking and stick to your trading discipline.